Good morning, and thank you for joining us on this exclusive webinar with the Entrust Group and the National Healthcare Development Fund. This morning's program is Healthcare in America, how the changing landscape is creating new healthcare investment options. My name is Gary Kowalski. I'm the Director of Sales for the Entrust Group. We have as our special guest this morning Ronnie Hale. As I mentioned, Ronnie is with the National Healthcare Development Fund. He is the portfolio manager, and the fund is the nation's first asset-based operational hedge fund investing in the fast-growing area of freestanding emergency rooms. A couple of quick items we're going to go through while people are still logging in. First of all, this webinar is being recorded. For those of you who wish to listen to it again later, or forward a link to a friend. On the Entrust Group website, if you click on Learning Center and then Events, there's a section on the left entitled On Demand Webinars. You can click on that and the program should be uploaded by sometime tomorrow. Second, in the lower left-hand corner of your screen, you'll see a chat box where you can submit questions for either Ronnie or myself. We have a lot of information to go through this morning, so we may go through some of it kind of quickly. I'll be speaking for about 10 to 15 minutes on some background in retirement and the company itself, the Entrust Group, and self-directed IRAS, and then hand the baton to Ronnie, who will take on the bulk of the presentation, and we'll try to leave about 10 to 15 minutes to answer questions at the end. As well, you can always call either myself or anyone at the Entrust Group with your questions if we don't get to all of them, or certainly Ronnie as well. And at the end of the presentation, we'll have each other's contact information posted there. So one other item before we actually begin the formal part of the presentation, and that is to announce that the information that we're providing on this webinar is educational only. The Entrust Group does not provide investment advice, nor do we endorse any investment products or any investment companies. So as you're considering investing, whether through us or anyone, we would strongly encourage that you speak with your financial advisor, your CPA, attorney, etc., to investigate the products properly. Okay, let's look at this morning's agenda. As I mentioned, I'll be speaking for about 10 to 15 minutes. I'll begin with some background on the current state of retirement in the U.S., and we'll talk about some of the retirement plan options available to you through the Entrust Group. We'll talk a little bit about who the Entrust Group is and what self-directed IRAs are, as well as your investment choices. And then I will hand the baton, as I mentioned, over to Ronnie, who will speak on healthcare in America and some of the investment options available to you in that realm. Okay, what I'd like to begin with is a comparison between 1991 and today. The environment has really changed, and I think it's important for a lot of reasons. If you go back to 1991, at that time, 50% of workers in the U.S. expected to retire before reaching age 65. Today, that figure is only 23%, so it's more than cut in half. Similarly, 11% of workers back in 1991 expected to retire after the age of 65. So most people didn't expect to have to work that long. Today, that figure is 36%. And if you take into account the additional 7% today that feel they will never be able to retire, you're actually at 43%, nearly a fourfold increase from just 22 years ago. Additionally, more than 30% of U.S. households have less than $50,000 saved for retirement, and 49% of U.S. workers are not confident that they will retire comfortably. Now, why am I going through these statistics? Well, I presented these really to make a point. I think it's easy for us all, myself included, to procrastinate when it comes to retirement planning. It's easy to say that's 20, 30, 40 years down the road. I'll get to it in a few weeks or a few months. And the problem becomes many of us set it aside and then we don't get to it. And so I think it's great that people are listening this morning. You're trying to learn, taking an active role in your retirement planning. And it's important to start at the earliest possible stage. So I guess my point here is just to underscore, it's great that you're on, and do take it seriously. Don't set it aside because you'll kind of fall into this statistical category and then perhaps later regret it. So I'm just going to go very briefly over some of the retirement plan options available to you through Entrust. Many of you will be familiar with these from a cursory level, but you don't deal with them every day, so I think a brief review can be helpful. There are two types of individual retirement accounts, a traditional and a Roth. Traditional, generally speaking, your contributions are tax deductible and your earnings grow tax deferred. So if you begin investing at 40 and through your IRA and you begin your distributions at, say, 60, 65, 70, what have you, all of the earnings grow tax deferred until the time of distribution. So you actually can use that earnings power to leverage the earnings to earn more money for you. A Roth IRA is a little bit different. The contributions are not tax deductible, so you're using after-tax income to make those. However, the earnings grow tax-free. So if you're growing your account again for 20, 25, 30 years, once you begin taking distributions, there are no taxes. So that can be a very compelling option for the right circumstances. From a small business account standpoint, we have three plans: a simplified employee pension, otherwise known as a SEP, a savings incentive match plan for employees, which is known as a SIMPLE, and an individual 401k. The individual K and the simplified employee pension can be very compelling opportunities for small businesses because in 2013 you can contribute up to $51,000 annually to each of those accounts. So for the right circumstances, you can really set aside a lot in a short amount of time. The simple plan is a lot less common. It doesn't fit most companies well, but if you're a company with less than 100 employees, especially if you have a lot of employees who are lower wage earners, that can be very compelling and something to take a look at. If you have further questions on those, just give us a call, the 800 number at the bottom of the screen, and we can help you understand those a little bit better. The last category I wanted to touch on is what I would call specialized accounts, ESAs and HSAs, so education savings and health savings accounts. These are accounts that the earnings will grow tax deferred and they'll be tax free upon distribution if you use the proceeds for qualified education or health savings expenditures. So I think my slides are in a little bit different sequence than I anticipated, so I'm just going to jump ahead here. If I can. Okay, all right, now I'm on the right slide. Okay, so who is the Entrust Group and what do we do? Well, the Entrust Group is a provider, an administrator, and record keeper of self-directed IRA plans. We've been in the business for more than 30 years and have just about $4 billion in client assets under administration. We have a knowledgeable staff that's very focused on educating our clients and prospective clients. We do that through programs such as this, national webinars, local in-person events that you can attend and sit down and hear in person, or through a national CE program for continuing education. The continuing education is primarily for financial and real estate professionals, but can also be a great way to learn for the public. Probably the biggest thing that differentiates us from our competition is our local office and designated representative model. With most companies in the industry, you have an 800 number, you'll call up, Usually with a self-directed transaction, you're going to have multiple interactions with your provider. With most of the companies that are out there, you'll call, you'll get a different person each time, often having to start from scratch with that person. With Entrust, you have a designated representative that will shepherd you start to finish through your transaction. So even though you'll deal with some different people, you have kind of a key conduit that's overseeing your transaction and trying to help you through every step of the way. So gotta try to find this slide. There we go. Now, you've heard the term self-directed IRA, but you may not be familiar with what it is. So I just want to spend a couple of minutes talking about that and why it's important. Self-directed is an industry term for an IRA that invests in alternative assets. So as example, real estate or what Ronnie will be speaking about this morning, hedged funds and pool funds. You can also loan money out of your IRA or invest in a private company or precious metals and those kinds of things. The term self-directed, again, is an industry term, but all IRAs, whether self-directed or otherwise, are governed by the same regulations and the same Internal Revenue Code sections for an IRA that you would get through, say, Wells Fargo or Charles Schwab. Now, why would you want to consider a self-directed IRA? Well, to a large extent, I think it boils down to diversification. The breadth of investment options available to you through self-directed is far and wide, and we'll go into those in just a moment. When you go to a Schwab or a Wells Fargo, they have terrific products, but they're primarily focused on the public securities markets, stocks, bonds, mutual funds, and CDs. Whereas with self-direction, you can cover a very broad array of things that you may be either more comfortable or more familiar with, or you simply want to diversify beyond the regular public markets. And this allows you to do that. Yet again, the IRAs are the same as through the banks and brokers in that the contributions may be tax deductible and the earnings will grow tax deferred or tax-free. So it gives you an opportunity to make investment choices in categories and areas that you have a greater degree of knowledge and control in and can kind of pick and choose and investigate with a little bit more depth. So we're going to just quickly go through what you can and cannot invest in with your IRA, and then Ronnie will take over and go into the healthcare options. Within an IRA, it's actually easier to go through what you cannot invest in first because there are very few things that you can't invest in. Those are collectibles, life insurance, and S-Corps. By collectibles, I mean stamps, coins, baseball cards, wine, works of art, antiques, those sorts of things. There are exceptions to the metals and the coins in terms of bullion or coins of a certain purity level. If you have questions on those, again, just give us a call. It's a little bit beyond the scope of this program to go in depth on them. But really, those are the only things that you're limited by. So to take a look at what you can invest in, it's, again, a broad array. Most common for our clients is real estate, really of any sort, whether it's residential, single-family, townhomes, condos. People will do a fix and flip or invest for cash flow. You can invest in commercial, medical office buildings. We have a lot of clients that invest in international real estate as well. Of course, there are several other types of investments listed here. Oil and gas ventures, which I'll be doing a webinar in about 3 weeks. Hedged and pooled funds, which Ronnie will speak about, precious metals, private stock, etc. So the category is actually almost limitless. We've had clients invest in farmland, in cattle, in ATM machines, in vegetable oil that they import, even in burial plots. So it's really kind of limited by your imagination. Now, I went through all of that very quickly because, again, the bulk of this presentation is on healthcare and some of the changes that are occurring there and the options available investing in healthcare. So I'm going to introduce Ronnie and let him take that over, and then we'll leave about 10 to 15 minutes at the end for your questions. Ronnie, again, is the portfolio manager for the National Healthcare Development Fund, the nation's first asset-based operational hedge fund investing in the fast-growing area of freestanding emergency rooms. He is also the Utah director of the Hedge Fund Association. And Ronnie has an extensive background in the areas of mergers and acquisitions, capital raising, risk and asset management, secondary and primary market financing, corporate restructuring, and he's also targeted, acquired, and managed multiple commercial and residential development projects. So as you can tell, he has a broad background in financial services. It spans 26 years. And with that, Ronnie, please go ahead.
All right, Gary, thank you very much. I always appreciate working with you. And we have a lot of information to cover here today. So one thing that I want to point out right in the beginning before we begin this is feel free to contact myself either at our website or on the phone for any information that you need in the future that you don't get answered today. We're going to cover a lot of information in a fairly short period of time. And so as Gary said in the beginning, let's wait till the end. If you have any questions, feel free to text them in, those types of things. And we will work on answering most of your questions at the end of the presentation. So with that said, let's kind of get started here. Most of us have heard of a hedge fund. They're quite popular. One of the things, though, that in the word hedge, when it says hedge fund, it's kind of a misnomer, is that most hedge funds are not hedged. And hedging is basically where you're diversifying how you invest. So if you lose on one side, you make it up on the other side. And the reality is most hedge funds do not do that. Don't ask me why, but they don't. So with that said, a better term for what you're looking at in the way of hedge funds would be a pooled investment vehicle. Now there's traditional types of pooled investment vehicles, and their structures include the following: hedge funds, private equity funds, venture capital funds, healthcare funds, real estate funds, and hybrid funds, which are funds that combine the components of the above. And with that said, from an investor's point of view, there's a strategy we want to point out to you in the beginning, and I suggest you kind of write this down because it's one that sometimes, as basic as it is, many people forget when they're in the midst of trying to pick out an investment vehicle, a pooled fund to go into. You need to find the right pooled investment vehicle for you. So no matter who else you work with and you talk to, make sure that it's one you're comfortable with. You want to find one that provides targeted returns that you're looking for. And you also want to find one that hits the appropriate levels of risk. And different levels of risk, different people handle risk differently. If you're ultra-conservative, then you want to get into an ultra-conservative investment. If you're into a little more risk and you know how to handle those things, look for those appropriate levels of risk. Let's move forward here. We'll talk a little bit. In finding pooled investment vehicle, the right one, we'll talk about the different ones a little bit here. Hedge funds are popular and are mostly securitized-based pooled investment vehicle, and they use complicated arithmetic to determine the investment targets and returns. So most hedge funds, what that means really is that they're investing in various types of security-based pooled investments, whether it be stocks or other things like that. Hedge funds are intended for very seasoned, high-net-worth investors and institutions, and they can be just great investment vehicles, provided you find the ones that fit your needs. Next, private equity and venture capital funds, and they're common also, but they too can offer a high level of risk because of unknown factors. And many of these types of funds invest in risky business startups, and any business startup is risky. It's just how it is. They work on expansions of business, business turnarounds, and all of these are considered higher risk investments. So, now mind you, high risk is not necessarily bad. You just need to be very educated about it. So with that said, move on to the next slide. You also have real estate funds or investments that most of us can relate to because we all know something about real estate. And with the current recent economic collapse, Real estate is turning out to be a very good investment, but there are still a lot of risk associated with it and involved, especially with our fluid up and down economy that we're in. So you also have hybrid funds. And hybrid funds cover very large sectors of investments. They often mix different models and try to balance out a return. So some hybrid funds can be okay, and others can be risky too. You just have to, as I said in the beginning, make sure that whatever you're investing in, especially when it comes to your retirement funds, look and make sure that it has a proper level of risk and a proper level of ROI return for what you're looking to invest in. So moving on to the next one, when you're finding the right pooled investment vehicle for your retirement funds, you really want to consider, I suggest you consider blue chip categories that have an opportunity to grow conservatively. Now, blue chip categories, if you use that criteria, because remember, this is your retirement funds, if you're looking for blue chip categories and use that, along with the other research that you'll do, you will find that the healthcare funds or pooled investment vehicles in the healthcare industry, they really do fit that bill. And healthcare is a blue chip category regardless of most economic situations. So even if the economy is going up, the economy is going down, no matter what's happening, it still falls into a blue chip category. And many people ask us constantly how the new Affordable Health Care Act is going to affect the healthcare sector. And the simple answer is it's anticipated it's going to bring millions of new people into the healthcare sector over the next couple of years. It actually says that as of next year, 2014, there should be 30 million new people hitting the market in the healthcare industry. And that's very exciting from an investing point of view. Now, there are three general categories in healthcare from an investment point of view that we really look at. One is pharmaceuticals. You know, there are always new drugs coming out to help us with various healthcare needs. You also have new technology, where it can be new equipment, new knowledge about how things work or how to apply things, organics, etc. And then you also have healthcare delivery. Today, we're going to focus on healthcare delivery category for several reasons. The healthcare delivery category is where the biggest issues facing America lies, and as such, the biggest, potentially the biggest opportunities. It tends to have some of the lowest risk factors from an investment point of view. And then the biggest real reason is this, because no matter how good a new drug is or technologies are, if you can't get to it or it can't get to you, it does you no good. So how health care gets delivered is really a critical thing, not only from an investment point of view, but also from our individual needs. We have a little background on delivery systems here in the United States, current and past type of things. Currently, healthcare is at 15% of our economy. So it makes up 15% of our economy. And Bloomberg is showing us that it's projected to be 20% of our economy, 20% of the U.S. economy by 2021. Healthcare spending last year was $2.8 trillion, and it's projected that by 2021 it will hit $4.78 trillion. Now that's a $2 trillion increase in spending, money going through a pipe into healthcare over the next 8 years. A couple of things you need to understand. Emergency rooms are becoming the primary source of America's primary care. Okay? We tend to be going to emergency rooms rather than primary physician, and we will talk about why. With that said, emergency room visits are up 32% between 1997 and 2006. And since that time, they've increased 5% per year. And when you're looking at it from a point of view of where you're going and also where you're investing, that's important to know. The number of ERs, another issue, though, with them is the number of ERs, emergency rooms, has decreased by 20% in the last 20 years. And it's projected to decrease by another 30% over the next 7 years. Now, you've got more people going to them, you've got more people coming in, but you've got less number of places where they're going. The number of primary care physicians, now PCP in this case does stand for primary care physicians, and that has decreased. The family doctor has decreased. The place you go generally for your general health care has decreased by 41% over the last 20 years. And one of the main reasons really is because primary care physicians, they tend to be the lowest paid doctors of all. So, a person comes out of medical school, they get residency, they're in debt up to their ears, and the lowest paid doctor that they can go into, field they can go into is primary care. The other thing it does that you need to understand, it takes an average of 10 years from the time a doctor leaves residency until they really are considered a solid primary care physician. And those are factors that dictate that when a person comes out of med school and they're done with the residency and they're picking where they're going to go in their career, they're picking higher paid careers, just like any of us would do. By 2020, there are roughly going to be 66% of the primary care physicians needed to meet the demands. Okay? Now that's, again, sounds a little scary in some ways. The average wait time right now to get in to see your family doctor, your primary care physician, right now is 21 days. So you get the cold, the flu, you get sick, something happens. The average time it takes to get in to see your doctor is 21 days. So where do you go? You go to the emergency room. That's why the emergency rooms, their visits are up and those things. The average wait time, though, currently in an emergency room ranges between 3 hours and 7 hours. So for most of us, myself included, if I can't get in to see my doctor, who I may call first, and something I feel sick or the children are sick or those things, I'm going to take them to the emergency room, which is what we're doing as a country. And that makes emergency rooms really are becoming our delivery system, or where we go to get our primary health care. Now, there are some recent research, and it shows that there's a direct correlation between ER wait times and your chance of dying. So if you have something serious and you go in, you want to be able to get in and get quality health care immediately. And so there are some issues that are facing America right now. The impact of regulatory changes on health care. So we have the Affordable Health Care Act is going to bring 30 million new people into the health care system by next year. Now, from an investment point of view, that's great. But if you'll notice, the doctors are starting to ask some very, very serious questions, very tough questions. And the biggest one they're asking is who's going to provide the care for all these new people? Because right now we have a doctor shortage. We have a nursing shortage, we have a doctor shortage, we have a shortage of places for people to go and get their health care. And so it's not quite a panic, but it's a very serious question. Now, regulatory changes that allow the creation of what we've found called freestanding emergency rooms, and they are separate from hospitals. Okay? It's the same emergency room you get at a hospital, they just don't have a hospital attached to them. In 2010, there were changes in the laws that required the insurance companies to pay for freestanding emergency room visits at the same rate that a hospital-based emergency room visit is paid for. Now, that's important from the investor point of view, those who are going into that field and investing in freestanding emergency rooms. You want to know that you're getting paid the same as a hospital gets paid. And the laws also require the insurance companies to pay freestanding emergency rooms within 30 days of submission of a bill. And that's also critical from an investment point of view. And continuing on the impact, we're going to kind of shift off that a little bit. In 2009, the Commonwealth Fund, and the Commonwealth Fund really is a large fund that does nothing really but except for research, health care in the various developing countries. And they're very well thought of among the industry. And they rank the U.S. as last in quality of health care among similar types of countries and noted that U.S. care costs the most. So we cost the most, but yet the quality of our health care is under a lot of the other developed countries that we compare ourselves to. And just at the beginning of this year, there was a study by the National Research Council and the Academy of Health about how the U.S. compares to the international community, and they stated that the U.S. has a shorter life and poorer health than most of the other industrial countries. So there are some issues out there. Above and beyond investing, you want to be able to get quality health care when you need it. Okay, so current trends. One of the great things that are happening is the hospital is about to enter the open market. Until then, they've been in a closed, government-fed market, and there was no real accountability. Healthcare reform is expected to make the connectivity, electronic medical records, and transparency commonplace in healthcare. And what that really means for all of us is that you're going to be able to go online in the near future, and you're going to be able to rate a hospital. You're going to be able to see all the different things that go on in hospitals and how they compare, what the death rate is, the mistake rates are. You get to see, so you will be able to begin as a country to compare who's good and who's not. Now, one of the other trends is that by 2020, 1 in 3 hospitals is projected to close. So even though there's more people coming in, there's less hospitals, less doctors. Doctor shortages totaled by 2025 state that primary care physicians will be down a third, as we've shown. It also shows that surgeons will be down almost 40%. There'll be 37% less surgeons that are needed to give all of us the health care that we need. So we're going to talk about that a little bit. Albert Einstein said that in the midst of every difficulty comes opportunity. Now, there's three ways to look at this. A pessimist is going to look at this and say the glass is half empty. An optimist says the glass is half full. And an opportunist says it's the wrong size glass. And he goes out and creates a glass that fits the situation. I personally find that in real life there's a bit of all three. So we're going to kind of look at those three different approaches and lead into what we in the National Healthcare Development Fund are finding as great opportunities that are coming down the pipe, the investment pipe. A pessimistic view, they kind of look at it this way and say the number of people needing quality health care is going up fast. By 2020, the number of hospitals, emergency rooms that are needed to treat people is expected to decline by another third. The number of doctors needed to provide primary care for the growing number of people in the U.S. is expected to decline by an additional 33%. And the quality of health care that we get is expected to decline from its already questionable rate, and the cost of health care is going to continue to rise sharply. So a pessimist is going to see it as gloom and doom. With that said, an optimist, providing I can get to the optimist slide here. Everybody hold on a second. I seem to have gotten just a little, we seem to have missed. Pardon with me for just a second. I've just lost the slides. Bear with me while I find this again. Okay, there we go. Let's move over one. And an optimist looks at it this way. And says the hospitals will be entering the open market, and that's good for the economy, and that's good for us. They're also going to look at it and see opportunities for new, innovative means of delivering a higher quality of health care will come to the market, and those who can capitalize on market needs are going to prosper. So, and with that said, an opportunist looks at it like we do. And many investors we're finding are investing into funds and companies, both public and private, that are taking advantage of the new opportunities in healthcare and healthcare delivery, such as the freestanding emergency rooms. You're going to see these two acronyms. I have them both in here. FSER is freestanding emergency rooms, or FSEDs. Now, FSEDs and FSERs are the same thing. So over the next 5 years, as you're seeing those interchangeably used, you'll know they mean the same thing. So part of what we find as a fund is that there's some growing sector that's been born out of the needs we just discussed. In that sector, you'll find a lot of companies that are pursuing it. And the freestanding emergency rooms, and again, freestanding emergency departments are what they're commonly used too. These are not urgent cares. Okay, this is not an urgent care at all. These urgent care facilities do not have ER physicians. A podiatrist or a nurse practitioner can be the attending person at an urgent care facility. So you need to know that when you're going in because you want quality health care. Freestanding emergency rooms have board-certified ER doctors. They have radiologists, RNs. They have labs and scanning equipment. And these are the same ERs that are attached to hospitals, but they're out in the community. They can be in a strip mall. They can be on the corner, almost as much as almost a 7-Eleven can in some ways. And they're there to provide the quality of health care we need and to deliver health care to us. Now, they can handle everything from heart attacks and auto accidents right down to the flu, just like the ERs that are attached to the hospitals. And from an investment point of view, we're finding the income numbers are very good. These ERs, when they see one patient an hour, it drives around $13.5 million in revenue through the door per year, with typically very high net profit margins. And then you ask yourself this, because I do all the time, when's the last time you've seen only one patient per hour in any ER? The average is actually, depending on which statistics you look at, ranges between 10 and 12 per hour. So from an investment point of view, freestanding emergency rooms also usually have both the business factor the business itself of healthcare, as well as a real estate factor to capitalize on. Now, let's talk about how you can invest a little bit into healthcare opportunities. There are three basic ways to invest in healthcare. You can invest directly into a company itself. This type of investment can be good, however, you lack protection that the federal government provides, such as oversight by rules or guidelines and regulations. And this type of investment can leave an investor vulnerable. The second way is to invest through a public company. Now, investing through a public company can be a very good investment method. However, when you invest in a public company, you're investing in the stock of a company, and if the stock market goes down, you can potentially lose all of your investment capital. The third way would be to invest through a pooled investment healthcare fund. A healthcare fund can also be a good vehicle with some additional benefits. Those benefits are here. One, all of us in the healthcare or in the fund business, we have federal oversight by the SEC and FINRA. We also use third-party administrators who independently and at arm's length verify all your accounting and the transactions that occurred. Okay. We have some questions coming in already. That's good. So the second thing you get is a lot of times you get these independent administrators, and they give you they're the ones that send you out your monthly statements, and they verify everything. And this structure gives investors security in the fact that an independent company has verified the books each month. Now, pooled funds also have third-party auditors, and they audit the fund annually. And funds are audited every year by the independent auditing firm. They audit not only the company, but they also audit the third-party administrator to ensure that all the records are accurate. And it's at the third layer of security to know your investment is being handled and accountable properly. Okay, now, most healthcare funds are asset-based as well as I said before, they have the business component and they have an asset-based component investment. The assets can include commercial real estate, high-tech equipment, and intellectual properties. And as asset-based funds gives an additional benefit to the tangible value versus stock only, which is intangible. And you need to keep that in mind when you're looking at things. And I do realize we've got a lot of questions actually coming through here, so we'll look at those at the end. There's some great questions coming in. Healthcare funds are generally also non-correlated to the stock market. Now, non-correlated investment means that its performance is not tied to the stock market. Therefore, you won't take large swings when the market swings back and forth. Blue chip sector investments are usually more stable than other types also. So again, when it comes to your retirement funds, I really suggest that if you're going to look at this, you look at blue chip sectors. Most healthcare funds pay a combination. There's usually a fixed annual return. You'll find somewhere between about 4.5% to 10% or more as far as your fixed annual return. They also have a large split of the profits, which range anywhere from 50% to 80% of the net income, which greatly enhances the investor's annual return. The fund itself generally also has control of all of the assets, so they can turn out to be very profitable. Most healthcare funds, type funds, have government oversight, as we said before, by the SEC and FINRA to help kind of protect the investor. One main drawback to pooled funds, though, is the investment fund is not for every investor. Not everybody can invest in one. Funds are generally limited to a total of 99 investors. All investors must be accredited investors. So this type of investment is not really for every investor. That's the only real downside to it. There are ways to get into it. I'll talk about your due diligence and some of the things that you really do need to look at. And they're important. Each one of the pieces is general here, but we will give you as much information as you want on each one of these points, as well as how to go about it. And we can point you toward, I can also point you toward resources to find this. So any of you become interested in pooled investment funds, do feel free to use me and to use the fund as a resource to gather your information. So one thing you need to understand is the fund structure and its investment strategy. Is this fund how is it structured is important. Is it going to invest in stocks only? Is it going to invest in businesses? Is it diversified? What is liquidity in this investment? Great. Okay, we'll get to that in a second. you want to know the structures and the investment strategies, and you have to be comfortable with those investment strategies. Okay, you also want to know how is the fund assets, how are they valued? Okay, you need to understand the fee structures. In a fund, generally, I guess a common fund fee structure is called a 228 or 2 and 20. So the funds charge 2% per year as a management fee, and then the funds themselves, the management companies, will end up taking, in this particular structure, 20% of the profits and leave 80% of the profits in assets to be divided among the investors. So that's kind of something you need to understand, and we'll go into that not so much in this particular webinar because it's much more information than we can cover. But you do need to understand the fee structure. You need to understand the limitations on your right to redeem. Different investment pools have different rights of redemption. So how much you can take out, when you can take it out, and the process by which you take it out. So we'll go into that a little further in the questions and answers. You also need to understand the ability and the background of the manager as well as the management team. And these are important things in your due diligence. You need to find this information. We can show you how and where to get this information from various sources on any pooled fund that you decide you want to look at. Okay, information that you need to seek. You need to read the fund's PPM, and the PPM stands for Private Placement Memorandum. Okay, and you need to be able to read that thoroughly. You need to read their marketing materials. You need to see how they go out and market and the things that they do. You also need to check on who the third-party administrator is. Check on who the third-party auditor is. You want to check the background in each one of those individuals. We also suggest you check their legal representative. All funds have a law firm that represents them. You want to look for quality firms in all three of those categories. And as always, have your attorney or your other financial advisors review the fund's documents. You know, this is a complicated structure in some ways. There are risks there. And so have other people that you trust look at these things. This is important. So to wrap up before the questions, let's take a look at this. According to a study by the U.S. government, healthcare spending is predicted to increase from $2.8 trillion to $4.78 trillion over the next 7 to 8 years. That's a lot of money going into a particular sector, and it is a blue chip sector. The projected trends over the next 20 years is that healthcare delivery will be primarily facilitated through emergency rooms as your point of care for your primary care for most U.S. citizens. That's where we go. You get a cold, you don't want to wait. The current structure of healthcare delivery system is also creating some tremendous opportunities for investors due to many factors that the data points we've discussed here today. And you'll be able to, we'll get you more information. As I said, this is a brief overview, a lot of information there. Yes, this presentation is available, and yes, we will get copies of it to you. So since we're here for further information, here's how you can contact me. You can contact me. My office is 801-998-3393. My email is rhale@nhdfund.com. And you can also go and register at the National Healthcare Development Fund. There's a button for registering as an investor. I'll speak with you personally. I'll answer all of your questions. Those of you who also want more information concerning your IRA or any type of retirement funds, Gary here, this is his information for how you can contact him. And we really enjoy our relationship with the Entrust Group. They're a great group. Gary's email is here also. Also their website where you can get further information. So since we're now kind of a little farther into, we've got about 14 minutes left. I do have some questions that I've come across, okay? And I'm going to answer some of those questions. So any of you that happen to have additional questions, feel free to type them in, and we'll go over them. Right now, we have Paul Bernard. And Bernard asked, what do you expect to happen to the current fee-for-service model of healthcare reimbursement, which delivers the bulk of the economics today? Okay, Paul, short and long. That's a long answer to a very short question. And we really don't have the time to cover that here. What do I expect? I expect, as most people in the healthcare delivery model or delivery systems, that you're going to see some tremendous modifications to this. I've got a lot of information that I can do. So if you will be more than happy to contact me, email, go to the fund, or call us, I'll deliver it to you as soon as I get your contact information. A lot of information on this. You're going to see changes. A lot of people say that it doesn't work very well. Yes, Yuri, this is live. Okay, so you can put in questions. So Paul, I hope that answers your question as best I can. It's going to change, and it's going to adapt tremendously. There's a lot of information on it. So feel free to contact us. I'll get you additional information. I kind of need to go into the background on that before I'd be able to really explain it so the rest of everybody could follow it. So Julio, I'm hoping I'm saying that right. What is your point of view on how these freestanding emergency rooms will be staffed with the bleak outlook in terms of doctors, nurses needing to run one of these freestanding emergency rooms? Well, that's one of the nice things. Let me explain this very clearly. It's one of the great things that we're finding as a fund in the various companies that are putting these together. A doctor or nurse or people who work for the hospitals generally are not shareholders. They generally just work there. There's a trend where they call them fillers. One of the fund's primary principles is a current emergency room physician. And he gives us a tremendous amount. He's helped us put this together. He's one of the principals in the fund. And he says that, you get a lot of doctors that they just fill. They're on a shift. They could be in 10 different hospitals over the next 20 days, and they just bounce in and out to fill shifts. So what we're finding is that most of the freestanding emergency rooms, and I can't say all of them, but most of them we've come across, the doctors are partners. They have tremendous incentives. They get paid better. They become partners in them. And so it tends, the freestanding emergency room tend to attract the better quality of doctors, because a doctor who puts his time in, and he's got a concern for the business because he's also an owner in the business, we get better quality doctors and nurses. The freestanding emergency rooms tend to make all of the employees stockholders, so everybody takes a participation in it. And so we see that the higher quality of nurses, radiologists, doctors, the surgeons and stuff coming to them and flocking to them to try to work there, because they can't get this type of involvement or commitment or connection in the current system. So I'm going to shift to the next question. I've got Stephen Vickerman, and he's, what is the liquidity of this investment? Liquidity comes down to the structure of the fund. Okay? A lot of funds will allow you to redeem. They'll have a hold period. Usually it can be anywhere from 6 months to the first 2 years. Once your money goes in, it stays in. That's a common thing. You will also find that if there was, say, various other factors in there on the liquidity side where you can get the money out, you can get it out at different times. Sometimes it's redeemed quarterly. Sometimes it's redeemed semi-annually, and sometimes annually. You go back to your due diligence, and when you're looking at the PPM, you're going to find what your liquidity factors are. And it's one of the points in due diligence that we really suggest you thoroughly understand. Okay, I'm going to shift to, I hope that answers your question. I'm going to go to the next one. How does one become an accredited investor? An accredited investor is something that the IRS and the SEC tag team want to really come up with. An accredited investor generally has $200,000 worth of income per year for the last 2 years, or $300,000 combined income, and or they have $1 million in net worth. And that's the general to $1.5 million. Things have actually changed just recently. They're resettling into the exact definition. I suggest you go to the SEC website, sec.gov, and look up the terms, and it'll tell you exactly what an accredited investor is. Now, some people will get together and pool their resources with other investors to be able to invest through companies. So there's a lot of options, but that's how you become an accredited investor. Now, Steve Steve, I can't say your last name, and I don't want to butcher it. He's asked, is the presentation available? And if so, can I receive a copy? Yes, the presentation will be available. I think Gary has talked earlier and said that it will be available on the website. You can also contact us directly, and we'll make sure you get copies of this so you can follow up with it. And then it gives you a great resource to start your due diligence. Let's see. I've got...
Steve, hi, Ronnie. This is Gary again. Just to jump in on that. Steve, I mentioned at the very beginning of the program, on the Entrust Group website, which is www.theentrustgroup.com, if you click on Learning Center and then Events within the drop-down menu, you'll see on the left-hand side under Events, On-Demand Webinars. That means recorded webinars. So by sometime tomorrow, most likely, we'll have a link where you can listen to or replay this event. If you would like a copy of the slides themselves, just email either Ronnie or me, and we'll be happy to send them to you. We're not going to distribute them to all registrants, but if you make a request, we'll be happy to disseminate those.
Thank you, Gary. I appreciate that tremendously. Let's jump in here. I've got Paul. Paul's asked, Paul, you've asked a very complicated question. If not an accredited investor, you mentioned pooling. What are the vehicles for investing in pools? Contact me. I'm going to have to send you the information, the exact information on that as per the SEC and other regulatory bodies. It's a complicated structure to a point, and it's easier just to give you the information than to try and explain it in the 3 or 4 minutes that we have here. So I hope that's not putting you off. I just want you to know that there's some structure to it. You need to have. So if any of you want to know more about that or any other questions, feel free to give us a call. Are there any other questions? I think we've answered most of them so far. We've got a lot of people out there still. If I've got one coming across here, a copy. Okay, Steve sent in his email. We'll make sure you get that, Steve. Gary, is there anything else you want to say as we wrap this up?
No, I want to thank everyone for joining us this morning, and as I mentioned at the beginning, we were trying to compress a lot, so I went fairly quickly. So I appreciate everyone's patience with us, and thank you for attending. And as Ronnie said, if you have questions about pool funding arrangements or the National Healthcare Development Fund, just get in touch with him via email or phone. And likewise, if you have questions about retirement programs, IRAs, or individual 401ks, feel free to give a call to me or to our office or send an email, and we'll do our best to try to respond to all of your questions.
Sounds good. Gary, it was great. Everybody have a wonderful day.
Ronnie, thank you very much for leading this morning. And I see one other question.
Good question. Gary, can you go ahead and do that?
Oh, of course. Norvell, yes, if you would just email, we'll try to leave this screen open for another moment or two. If you just send an email to either Ronnie or to me, and our email addresses are on the screen. Ronnie is rhale@nhdfund.com, or I'm at G Kowalski, that's Kowalski, at theentrustgroup.com. Or give us a call. We'll be happy to send you a copy. As well, the program will be available for download on our website.
Great resource. That website's a great resource for you.
So, but that's it. If there are other questions, feel free to get in touch afterwards. And you're welcome, Norvell. I'm glad that came through to you okay. And Ronnie, I thank you again, and I wish everyone a terrific day.
Okay, you have a great day. Everybody enjoy yourself, and remember there are great opportunities out there.
Thank you so much. Bye-bye.
Thank you. Please stand by.